We're jumping straight into Pure Storage today. Everyone is watching the price action, but the real story is the AI infrastructure build-out.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
It is great to be back.
Yeah.
And look, let's just set the scene for everyone, because if you've been watching your portfolio...
Which I know everyone has been, obsessively.
Oh, absolutely. You've probably seen Pure Storage just bouncing all over the place.
Yeah.
It's been a bit of a roller coaster.
For sure.
The stock's trading right around $72. Now, for context, because context is everything, that's a pretty big drop.
A huge drop. It's down, what, nearly 30%?
We're talking 27% from its 52-week high. It was, flirting with almost $99 not that long ago.
Right. And usually when you see a pullback that steep, you expect some kind of disaster.
You expect a dumpster fire.
Yeah, exactly. You're looking for missed earnings, lowered guidance, some kind of scandal.
And that's the thing. That is the hook. The price is down, sure, but the company just dropped a massive 16% revenue growth number.
16%.
And they actually raised their guidance.
Yeah.
So the market is just completely confused.
It's a total contradiction.
So is this a value trap, where you catch a falling knife?
Mm-hmm.
Or is this a massive AI opportunity that's just sitting on the clearance rack? That's what we're unpacking.
I think part of the confusion honestly comes from the sector itself. Storage just sounds boring.
Oh, totally.
When people hear storage, they think filing cabinets, dusty server rooms, It doesn't have the sizzle of a new app or a robot doing a backflip.
It sounds like you're buying office supplies. But you have to shift your mindset here.
Okay.
This isn't filing cabinets anymore. This is the plumbing for the entire AI revolution. We're talking about the infrastructure that lets Meta and NVIDIA do what they do.
That's a great way to put it. If the plumbing in your house breaks, it doesn't matter how nice your sofa is.
Exactly. If the plumbing breaks here, the AI just doesn't work.
So if you want to play the gold rush, you buy the shovels. Or in this case, the pipes.
That's the play. And hey, if you want us to keep finding these kinds of setups where the noise and the signal are going in opposite directions,
do us a favor.
Yeah, please subscribe to the show, hit that like button. Our whole goal here is just to simplify the noise so you can make better decisions. We do the heavy lifting for you.
So let's get into it then. The bull case, the blue sky scenario. Why are some investors looking at this dip and just piling in?
Okay, so you mentioned that 16% revenue growth. Let's dig into that.
Is 16% actually impressive right now?
It is, especially for hardware. We're looking at their Q3 fiscal 2026 numbers. They pulled in $964 million in revenue.
Up 16% year over year.
Exactly. But you know me, I always say the raw number is less important than the trajectory.
Right. Are they speeding up or are they slowing down? A car going 60 is great, unless it was going 80 a minute ago.
Precisely.
Yeah.
And they are accelerating. This isn't a company that's slowing down. They've got a projection out there for fiscal 2027 of $4.29 billion in sales.
Wow.
And when you see a legacy hardware sector that's usually growing at low single digits, and then you see a company accelerating into double digits, that's a clear signal.
It means they're taking market share.
They are eating someone else's lunch.
Okay, so that implies a competitive advantage, a moat, right? But I have to play devil's advocate. What stops a Dell or an HP from just selling cheaper hard drives? Isn't storage a commodity?
That is the big misconception. It's the biggest mistake people make here. If you're just storing old Word docs, sure, go buy a cheap spinning disk.
Go to the bargain bin.
Right. But Pure Storage isn't selling hard drives. They're selling all flash array technology.
Let's define that. We're talking flash memory, like in a smartphone, versus the old spinning disks.
Exactly. Think of a record player. That's a spinning disk. It's mechanical, it's slow, it generates heat. Flash is instant. It's electric, much faster, much cooler.
But anyone can buy flash chips, right? So where's the moat?
The moat isn't just the hardware. It's the software that wraps around it, what they call the enterprise data cloud.
And how does that create a moat?
Think about it. Once a huge company moves all their data onto Pure's platform, and they start using that software to manage it across Amazon, Azure, their own servers, it becomes incredibly sticky.
The switching costs are huge.
Massive. You don't just rip out the foundation of your house because you saw a cheaper brick on sale.
Makes sense. Once your IT team learns the software, you're locked in. The pain of leaving is way higher than the cost of staying.
Yep.
But let's circle back to what you said at the top, the real story being the AI build-out. How does a storage company fit into the AI boom? Is it just storing training data?
It's not just storing it, it's the feed rate. Think about the bottlenecks. Companies are spending billions on NVIDIA H100s. These are the Ferraris of computing.
Right, the brains of the operation.
Correct. But a brain needs information. And if your storage is slow, if it can't feed the data fast enough, those expensive NVIDIA chips are just sitting there doing nothing.
They're idling, and idling chips is just burning cash, an expensive parking lot.
Precisely. AI models, especially at Meta and NVIDIA, are ravenous. They need huge amounts of data, instantly. Pure is positioning itself as the only way to keep those processors fed.
So it's about speed, latency.
It's all about latency. Their FlashBlade systems are designed for the chaotic, massive data requests that AI generates.
So you pay a premium for the storage so you don't waste the massive investment you made in the compute side.
It's an insurance policy for your GPU spend, speed and efficiency. And this explains their spending. You'll see bears complain that Pure is spending a lot on R&D.
But that's a feature, not a bug, right?
It's an entry fee to play with the hyperscalers. They're engineering their systems for the insane demands of Meta and Google.
I see. So that investment aligns with their business model shift too, doesn't it? They're not just selling boxes anymore.
Right. This is the other huge pillar of the bull case. Legacy storage was transactional. You sell a box, you walk away. Pure is moving to a subscription model. Evergreen one.
Which is basically storage as a service.
Bingo. Instead of a one-time sale, they're selling a subscription. It's a SaaS model. They manage the capacity, they upgrade the hardware for you. No more forklift upgrades.
For the customer, that's great. For the investor, that means recurring revenue.
Which Wall Street absolutely loves. It's predictable, it smooths everything out, and it creates that stickiness we talked about. It turns a purchase into a utility bill.
Right. And what about the balance sheet? Cash is king right now.
Oh, they're sitting pretty. $4.2 billion in assets. They are cash rich. And management just authorized a $400 million share repurchase.
That is a very strong signal. Management is telling the market, we think our own stock is cheap.
They are betting on themselves. So you combine accelerating revenue, a sticky subscription model, the AI angle, and a fortress balance sheet. That's the bull case.
It is a compelling story. It really is. But let's take off the rose-colored glasses.
Time for the flip side.
If everything is so great, why is the stock down 27%? What's the bear case?
Okay, let's unpack the risks, because they are real. And the first one just smacks you in the face. Valuation. Even after this drop, this stock is not cheap.
It's still trading at a premium.
A significant one. Pure trades at roughly 7.2 times sales.
Whoa, okay.
Now, for a software company, that might be okay. But for hardware, the industry averages around 1.7 times sales.
1.7. And what about their direct peers like Dell or NetApp?
They're around 2.4 times sales.
So Pure is trading at nearly triple the multiple of its peer.
It's priced for perfection. When your valuation is that high, any tiny slip-up, any piece of bad news, the trap door opens. That's why you see this volatility.
That brings up profitability. Revenue growth is great, but where's the cash? What do the margins look like?
And that is the second arrow in the bear's quiver. The margins are thin. Net margins are around 3.7%, and that's actually down from 4.2% the prior year.
Wow. That is incredibly thin. That leaves zero room for error.
Zero. And this connects right back to the hyperscaler point. We said landing Meta is great for revenue, looks great in a press release.
Right, it's the headline you want.
But there's a catch. We call it the hyperscaler trap. When you deal with a giant like Meta, they call the shots, they demand huge volume discounts, custom engineering. They squeeze you.
So you get the top line growth, but the actual profit on each unit sold gets compressed.
Exactly. The bet Pure is making is that volume will make up for it later. We'll take the hit now to own the market. But right now, it looks like they're doing a lot of work for very little profit.
That profitless prosperity worry.
That's it.
Okay, any other red flags?
There's a little bit of insider activity that spooked some people. The chief product officer sold about $482,000 worth of stock.
To be fair, $500,000 isn't always a massive signal. It could be for taxes, a house.
No, it's not huge relative to his holdings. But the optics matter. When the stock is dipping and an insider is selling, it's just not a good look. It adds fuel to the bearish fire.
So the fear is they're getting squeezed on price by the AI giants, their margins are thin, and the stock is still expensive compared to its peers.
That's the fear in a nutshell.
Yeah.
You're paying a Ferrari price for a company that's currently making Toyota margins.
Okay, a clear battleground. So for the listener trying to figure this out, what should they be watching in the next month or two? What are the triggers?
We have some very specific things coming up. The biggest one is earnings.
Q4 earnings coming up in early March.
Yep, early March. That's the moment of truth. You have to watch the revenue guidance number like a hawk. They need to hit that $1.02 to $1.04 billion range.
And if they miss or guide lower,
It will get punished. It will be ugly.
okay, beyond the top line, what's the key metric inside the report?
The subscription mix. This is the key to the whole margin story. You want to see the percentage of revenue from that Evergreen One service going up.
What's the magic number?
If that number ticks over 35%, it proves the margin expansion story is working. It proves they're becoming a software business.
Got it. Now, what about the supply chain? There was some news out of that NetApp conference a few days ago.
Yeah, this was a really interesting detail. Management talked about NAND prices.
The flash memory chips, the raw material.
Right. And NAND prices are rising. Usually, your input costs going up is a bad thing.
Of course.
But management said the supply tightness is actually helping them.
How? That sounds totally backwards.
Because when supply is tight, it gives them pricing power. They've managed their inventory well, so if you're one of the few players who can actually deliver, you can charge what you want.
It creates urgency for their customers. They have to buy now.
Exactly.
Yes.
So listen for comments on that. And also, keep an ear to the ground for any unconfirmed rumors about expanded deals with hyperscalers.
Yeah.
An official announcement there would be a huge catalyst.
It sounds like the next month is going to be absolutely pivotal.
It is.
So let's bring it all together. The growth, the AI thesis versus the valuation and the margin risks. What's the lowdown? How should people think about this?
Okay, here's the lowdown. Pure Storage is a classic growth at a reasonable price battleground. You got a 26% discount on the stock. You got massive AI tailwinds. But you're fighting against those thin margins and that high valuation multiple.
It's not a slam dunk. It requires some conviction.
It does. And here's the final thought I'll leave you with. Think about the time frame. This is not a quick flip. The consensus is for earnings per share growth of 44%.
44% is massive.
It is. But to get there, you have to be willing to hold through this investment phase. You have to hold while the margins look ugly because they're spending to build that future.
The market hates uncertainty, and the margins are uncertain right now.
Exactly. But if the thesis plays out and those margins expand as the subscription model takes over, $72 might look like an absolute steal in 2 years.
It's the difference between trading the stock chart and investing in the business cycle.
Precisely. You have to decide if you believe in the plumbing of the AI revolution enough to wait for the profits to catch up.
That is a great place to leave it. A very clear choice for the investor.
Thanks for joining the Easy Money Show. Keep your eyes on the data, not just the headlines.
See you next time.